Hello, and a warm welcome to you all. I'm Lillian Chin, Director of Client Partnerships with La Trobe Financial. Our September investor update comes at a time when our two largest cities, Sydney and Melbourne, are both deep into COVID-19 lockdown. In fact, Melbourne has now achieved the dubious honor of enduring the longest period of lockdown of any city in the world. But the news is not all bad. Vaccination numbers continue to increase, and state governments are following governments around the world publishing roadmaps to reopening. As we approach the end of the year, we can see the prospect of a brighter future ahead. Of course, at the end of long restrictions, the economy will undoubtedly have been impacted. It waits to be seen whether we will experience a rebound of the same pace and enthusiasm as we experienced at the end of 2020. Underneath all of this is an environment of ultra-low interest rates and continuing market volatility. Self-directed investors and retirees who paid off home loans with interest rates near 20% per annum are now trying to meet income and lifestyle needs with investment rates near zero. So, these remain challenging times on a number of fronts. At La Trobe Financial, we have often spoken about the importance of transparency and knowing exactly what you are investing in. In today's webinar, we will include a focus on our regulatory landscape along with the updates on our portfolios, the property market, and the economy. So again, thank you for joining us. Today, you'll be hearing from key asset management executives to assist in relaying our thinking and insights. Troy Stratton, our Deputy Chief Investment Officer, has over 22 years' experience, both in London and here in Australia, across banking and wealth management. Troy has worked in senior roles with Barclays Wealth, Barclays Private Bank, and HSBC Retail and Wealth Divisions. Michael Watson, Head of Distribution Asia Pacific, has been with La Trobe Financial now for a decade and has worked within various market-facing and project roles. Michael's background is 20 years across bank and non-bank financial institutions within credit analysis, portfolio management, distribution, and operations. And finally, to me, as Director of Client Partnerships, I have over 21 years' experience in the domestic and international private banking industry. My roles have included Regional Executive in Westpac Private Wealth and working for Merrill Lynch, HSBC, and Citibank in Singapore. Let's begin with a brief corporate update. The La Trobe Financial Group is Australia's leading credit asset manager. We commenced operation in 1952, have 13 billion in assets under management, and employ over 440 staff here in Australia. Our business has two key growth engines. Our asset management business is spearheaded by our 6.5 billion credit fund, which has 55,000 investors and operates in the $3.4 trillion managed fund sector. Our real estate credit finance business draws on our deep expertise in credit to deliver one of the broadest mortgage product suites available in the 2.5 trillion residential and commercial mortgage market. Both markets have enormous depth and diversity and offer tremendous opportunities for us to grow and strengthen our offerings. Finally, we are a portfolio company of the New York-based Blackstone Group. Blackstone has over US $684 billion in assets under management and owns 80% of the business, with the remainder owned by senior management. Blackstone's global network of businesses gives us real-time insights into market trends that complements the insights we derive from the circa 13 billion in assets we originate annually. A key point of difference for our business is the diversity of our investor base. We have an unparalleled funding book spanning the world's largest banks and financial institutions, with whom we have 3.7 billion in mandates. Debt capital markets. We issued almost 9.2 billion in RMBS bonds, and of course, our 6.5 billion credit fund. This profile is unique in the market and allows us to capitalize on growth and portfolio opportunities beyond those that our peers can pursue. And that's to the benefit of all our investors. With that brief overview of our business and funding, let's now turn to review of the risk and governance framework we operate in. In today's market, the hunt for yield is a very real and seemingly permanent challenge for investors. Investors of all kinds, therefore, are looking towards investments they may not have previously considered. It is just so important that investors understand the risks in any product they choose to invest into. Accordingly, we will use this presentation to discuss the risk and governance environment La Trobe Financial operates in and our overall risk culture. Over the next few slides, we will take a look at the macro regulatory environment. What changes are expected in the coming months and how we are adhering with this while we complete our credit assessment and investment management practices. Let's begin by taking a look at Australia's macro regulatory environment. Australia has a strong reputation globally for its comprehensive regulatory framework and rule of law. The Council of Financial Regulators, comprised of the Reserve Bank, APRA, ASIC, and the Treasury, operates to ensure the finance industry is well regulated, unified, and efficient. Within its various operations, La Trobe Financial follows regulatory requirements of both ASIC and APRA, as well as various Commonwealth laws governing lending and investment operations. La Trobe Financial undertakes its asset management operations via its Australian Financial Services Licence and its lending operation under its Australian credit licenses. Regulation is rarely static and has kept pace with the changing face of financial services for many years. The current cycle of regulatory tightening can be traced back to the Wallace Report on the Australian financial system. Dating to the mid-1990s, the Wallace Report was instigated by some high-profile corporate failures arising from the early 1990s recession. On screen now are some of the regulatory changes and interventions of the past 8 years alone, designed to protect consumers and ensure Australia's financial industry is operating to the highest possible standards. You can see the volume and pace has been significant. Most recently are the changes required for the design and distribution obligations and the responsible lending obligations. These cover design and distribution requirements, the tightening of lending standards, bank liquidity requirements, and other targeted interventions to address any perceived market hotspots. Each of these are taken into consideration when it comes to our credit assessment and asset management activities. Any listeners to our presentations over many years would have heard us repeatedly speak of the importance of quality asset selection. After all, it's the assets of the portfolios that drive returns for investors. So, let's now take a look at how we assess the loans which form the assets for our investor portfolios. From a pure risk systems perspective, the underwriting process for our loans is a thorough, industrial strength engine that sees us extract these highest quality assets from our asset class. In short, our loans predominantly start with mortgage brokers, each either credit representatives of an Australian credit licensee or an ACL holder in their own right, and subject to legislated best interest duties as outlined in ASIC Regulatory Guide 273. In conjunction with the borrower, brokers find a range of suitable loans for the borrower based on, amongst other things, financial situation, requirements, and objectives. Each of our loan applications is independently reviewed at the indicative approval stage by a fully trained credit analyst, and subsequently the formal approval stage by another fully trained credit analyst. Each credit analyst can only review or approve loans based on a scale approval authority based on experience and seniority. If a loan is complex or large in size, it may require further review at executive committee level. Finally, prior to settlement, all of our loans are certified by an external independent solicitor as being fully documented and forcible loans. When a loan is assessed, a key driver of our credit assessment is a review of the very traditional 5 C's of credit. This assessment reviews the character of the borrower, their credit history, stability, and asset accumulation, the capacity or their ability to meet the financial obligations of the loan, together with their other living expenses without undue hardship. This calculation also includes a sensitivity analysis with higher interest rate settings to ensure the borrower can afford the loan if rates rise. The capital or the borrower's skin in the game. La Trobe Financial requires a minimum 20% equity holding by the borrower, or in reverse, lend to a maximum of 80% LVR for residential, with a risk-adjusted scale for non-residential properties that we will explore on the next slide. The 4th C, collateral, refers to the asset being used as security. We have a liking for very granular, high-quality vanilla asset types. Think a suburban house or a commercial premises in an outer metropolitan business park. The sorts of properties which have a ready market of buyers at all points in the economic cycle. The 5th and final C is conditions. These are the additional requirements unique to each borrower that we place on the loan approval. I'll now hand to Troy, who will provide an overview of these assets, their quality, and how we use them to build portfolios within our award-winning credit fund.
Thank you, Lillian. Hello all. The graphs on the top of the slide show the volume and value of the borrower requests against the settlements process by a real estate credit division. Over the last 18 months, we purposefully tilted our lending offering to more residential loans as market uncertainty eventuated. Pleasingly, volumes of settlements recently completed across all of our lending products are close to, if not above, the historic pre-pandemic levels. Loan settlement volumes continue to help support the growth of the $6.5 billion credit fund. La Trobe Financial operates a significant originations engine with over 3,500 accredited mortgage brokers providing us close to $1 billion of opportunities each and every month. These applications are subject to the rigorous assessment processes Lillian described earlier, and in the end we tend to fund across the cycle around 55% of these applications on average. It is the fish that John West rejects, after all, that makes the real difference. All of our work we do around mitigating risk in our assets ultimately is to the benefit of our investors. As I mentioned, it is the assets in the fund that ultimately drive the performance for investors. On screen, you can see that asset quality has continued to improve materially as our business has grown. Starting on the left-hand side, in June 2016, prime and super prime assets, the largest quality loans we invest in, were 28.2% of the portfolio. At the end of August this year, that had grown to 36.4%. Conversely, the higher yielding but riskier specialist assets were 19.1% in 2016. They are now below 8%. That's more than a 50% reduction. Another key comparison I'd like to draw to your attention is the credit quality of La Trobe Financial borrowers compared to our peers and the Big Four banks. While we have always undertaken rigorous hands-on credit analysis of our borrowers, we also undertake a credit check from third-party credit analyst provider Equifax. Equifax is an independent provider of credit searches and reporting in Australia, and among other things, provides a credit score for all borrower applicants. As can be seen by the graph on your screen, our borrower credit scores have sat around the levels seen by the banks. Notably, in January 2021, our average credit score even surpassed that of the Big Four banks' average, and has since maintained at or above bank credit scores. This is powerful evidence of the continued discipline and focus we place on borrower credit quality, and an easy gauge for investors to the quality of the assets that underpin our $6.5 billion credit fund. On that note, let's turn to the investment accounts within the credit fund. These products represent our views on how to best operate within this asset class to deliver value in the form of premium, low volatility income to investors across multiple investment durations. You can see on screen our full product suite. All our rates of return are variable and are reviewed monthly. All of our pooled portfolio products have strong track records of performance since inception, and as an asset manager, we are dedicated to providing investment products that deliver regular income to investors. With interest rates remaining at historical lows and inflation becoming a talking point for future consideration, a targeted exposure to our investment accounts could add real power to your investment portfolio's income profile. Our products offer a range of return and duration to suit most investor appetites. The distribution rates of our portfolio accounts represent the medium-term income settings of each. We set our rates at the optimum rate for the portfolio to deliver low volatility income for our investors, which doesn't fluctuate wildly. At 1st of October though, we are making a rate adjustment to some of our accounts. These represent a 20 basis point or a 0.2 reduction across most of our accounts, with no change to the classic, and a 25 basis point reduction to our 4-year account. This reduction is against a thematic of continuing low interest rates and competitive lending offerings, driving portfolio income. The underlying portfolios are extremely healthy, and you will recognise that this is our first distribution rate adjustments since December 2020. Of course, if you have any queries about any of our investment offerings, please do not hesitate to contact our friendly asset management team on 1800 818 818. Let's now turn our attention to the portfolio parameters of the flagship 12-month term account, which this month passed $5 billion in assets under management. Our flagship 12-month term account investment mandate maintains a deliberate bias towards residential assets. After residential, no other sector can take an overweight portfolio position. This ensures the more volatile sectors cannot negatively drive portfolio performance. Sectors like development loans and commercial loans can provide fantastic yields, but can also be more volatile. Beware of funds that offer a lack of diversification or overly weighted towards one sector like commercial property or development. The maximum loan to value ratios, or LVRs, a lender offers can make a big difference to the risk in a portfolio. The 12-month term account allows a maximum LVR of just 75% for metropolitan residential property. You will notice a risk-adjusted lower LVR for non-residential loan types. Importantly, the current weighted average LVR across the 12-month term account is just 64% at the end of August. Finally, a full and thorough diversification by geography can make a big difference to the portfolio risk too. We like our loan exposures to follow that population. A result of this is a lower maximum exposure to smaller and more volatile population centres. Accordingly, you can see that our maximum in New South Wales and Victoria of 50%, then 40% in Queensland, 20% in WA, and then just 10% in any of the other remaining states and territories. Beware of funds that offer a lack of diversification or are overly weighted towards one location in particular. That should be a real red flag for any investor. Covering off portfolio parameters, let's turn our attention to arrears and hardship. In short, in 2020, hardships peaked and receded swiftly, with no one sector or location overrepresented in our statistics, demonstrating strong borrower cohorts right across our loan book. As at the end of August 2021, across our entire fund loan portfolio of 9,332, just 45 are in hardship, and this represents just 0.8% of the total AUM in the credit fund. Just as pleasingly, the transition from hardship to arrears has also been ahead of our expectations. Arrears levels have continued their declining trend and are now below what we would normally expect to see in the portfolio. We anticipate no material change to these numbers, and to date, since the beginning of lockdowns in Sydney and Melbourne in particular, we have not seen a noticeable increase in either arrears or requests for hardship assistance. The final point to bring to your attention is the continued low levels of asset shortfalls across the portfolio. The table on the right of screen shows asset impairments or shortfalls across the fund portfolios as well below term averages. That speaks to the quality of the book. While the 1-year numbers can move around a bit, the 3-year numbers are reflective of the quality of the assets in the book. To put this into context, over the past 12 months, that represents only 3 cents for every $100 of loans in the 12-month term account has resulted in an impairment loss within the investment account. This is truly remarkable indeed. Let me bring your attention to one last point of discussion around our portfolios, and that is our performance over many years. On screen now is the performance of the 12-month term account in orange and our classic notice account in light blue. If you had invested $100,000 into them in February 2003 and reinvested the income, the results are extremely impressive, with the low volatility of the performance a real standout over our other asset classes. It simply keeps on performing month in and month out and producing monthly income yields above market for investors. That's important because it takes the question of having to correctly time the market off the table. And timing can make a real difference for most asset classes. This return profile can make a real difference to your own portfolios as investors diversify their portfolios to maximise income returns. Before I hand to Michael for our economic update, let me just point out a few of our recent recognitions. La Trobe Financial is pleased to have received 2 prestigious awards at the recent Elefanti Global Awards, an international awards recognising organisations that demonstrate corporate excellence in the fields of business innovation, leadership, technological achievement, and employee engagement. It is one of the world's leading ceremonies of business awards and personal honours. We are proud to announce that in July we were recognised in the following categories. 1, we were the winner of CEO of the Year for Wealth Management. Across Asia Pacific, it was awarded to our Deputy CEO and CIO, Chris Andrews. and 2, the Non-Bank Financial Institution of the Year for Asia Pacific. These awards are recognitions of our unshakable commitment to over 7 decades to put the customer at the heart of everything we do. Now, with that very detailed summary of our products and our portfolio construction, let me hand over to Michael.
Thank you, Troy, and hello all. As we mentioned at the start of the investor call, we are in a unique and interesting moment. Vaccination numbers continue to edge ever upwards. Restrictions are poised to ease. We can perhaps tentatively look forward with some confidence towards entering the long spoken of new normal. With all of that in mind, let's take a look at what this has meant for the property market and the economy generally since our last update. Let's begin with a look at the local economy. And to quote Reserve Bank Governor Lowe, the Delta outbreak has delayed but not derailed the recovery of the Australian economy. Indeed, these extended lockdowns have not been as hard on the economy as the lockdowns of 2020. Most serious commentators are still flagging only modest increases to unemployment through this year and next. And while it's not been easy, as we've been saying through all of the pandemic, the road to economic recovery will be bumpy. These outcomes are a real case for optimism. On that note, let's take a look at the current drivers of the economy with an update on the top 3 hot topics within our economic headwinds and tailwinds report. A headwind that may cause some serious drag on the economy for some years is the impact of closed borders. It's forecast that by 2031, Australia may have more than 1 million fewer people than would otherwise be the case. Population growth is a driver of economic activity in any country, and strategically important with our demographics tilting towards an ever-ageing population. In addition to potential impact on housing prices, the extent that these population forecasts prevail or are addressed could have long-lasting impacts on our economy and our standard of living. As we're experiencing presently, the go-to government response in lieu of a highly vaccinated population is rolling lockdowns. Indeed, every mainland state has experienced some level of lockdown over the last 6 months. These lockdowns do have a distinct and immediate impact on economic activity, as demonstrated on screen. We'll continue to watch closely the impact of the current lockdowns on economic activity. The pace of Australia's vaccination rollout and the lack of a unified reopening strategy presents another key economic headwind. An unvaccinated population is prone to lockdowns under our existing strategy. What's more, the lack of a unified national strategy restricts businesses from reopening or forward planning with any confidence. Our 2 most populous states, New South Wales and Victoria, are progressing steadily towards vaccination goals. New South Wales has set a 70% fully vaccinated benchmark to reopen New South Wales. Victoria, on the other hand, has set a higher hurdle of 80%. New South Wales, at over 80% first doses, sends a tremendous signal that the fully vaccinated number will also reach that milestone swiftly. Victoria, at just over 72% of first vaccinations, has got slightly more to go. We note that the pace of daily vaccination numbers have begun to fall recently. This has also happened at other stages of the rollout. Whether this is just an ordinary movement in the cadence of the rollout or a sign we're reaching the ends of the population who will willingly be vaccinated, we'll watch with great interest. Let's now move to tailwinds, those factors which we anticipate will drive the performance of the economy in the period ahead. Starting with the macro commitment to expansionary policy settings. In 2020, we saw the success of fiscal policies such as JobKeeper and JobSeeker in maintaining employment and sustaining businesses. Together with monetary policies from the Reserve Bank, including maintaining low interest rates until at least 2024, we had a unified position of significant support. Importantly, this support has continued. State and federal governments have launched tailored, targeted mechanisms to support individuals and businesses. The Reserve Bank has reaffirmed its low rate settings and provided clear guiding objectives. With the federal and state governments all in, and the Reserve Bank of Australia are all in, this presents a real tailwind for the Australian economy. Australian households are, at a macro level, near their strongest ever cumulative net wealth position. In aggregate, households have an additional $167 billion in savings since the pandemic began. Investment in financial assets and rising property prices have seen wealth grow with only a minor impact from COVID-19. Importantly, the underlying liabilities have been stable and indeed reducing. This is genuine, unleveraged wealth creation that puts Australian households in great shape. A consequence of a lockdown economy, maintaining employment but with restricted opportunity to spend, has seen a spike in household savings ratios. This spike began to normalise, but is again rising with the most recent lockdowns. The end result has Australia household balance sheets in great shape and provides a twofold benefit or tailwind to the economy. First, high savings levels provide households with a cushion against future volatility, and this is hugely important as we navigate our way through this current period. Secondly, as savings rates normalise, this will ultimately manifest in a wave of consumption, supporting further growth in the economy. Unemployment numbers have been a standout data set of the past 12 months and have continued on that strong performance. Where multiple commentators had anticipated double-digit prints, unemployment peaked at just 7.4% before receding swiftly. It's now at the extraordinarily low rate of 4.5%. An employed population, of course, has multiple benefits: consumption, confidence, and of course, for governments, each employed person represents a taxpayer, contributing to national revenues. It's a testament to the robustness of the entire economy that unemployment is also uniformly low throughout all the states and territories. These low numbers represent people in work right across Australia, earning incomes and supportive of all the local economies around the country. Of course, no commentary on the economy would be complete without a look at the residential property market. As we've touched on in a number of our recent webinars, the property market has seen a surge in results right across Australia and is a clear example of just how robust this asset class can be. So let's take a look at the current state of play. It would be difficult to be unaware of the surge in residential house prices over the past 12 months. As a key component of individual wealth and a driver of our economy, residential property prices grew by 18.4% year on year nationally over the 12 months to 31 August. Every capital city has recorded double-digit annual growth, and with the exception of Darwin, which is a smaller market and more prone to volatility, each capital city appears to be on a strong trajectory against the backdrop of lockdowns. Key indicators around residential property prices are not, yet, showing any serious signs of abating. It's still very much a seller's market. Consider the two key points: auction clearance rates and the length of time a property is taking to sell. Auction clearance rates sit above the 10-year average, and the length of time a property sits on the market is likewise near long-time lows. As the charts on screen show, both are showing signs of moving towards more normal settings, but neither are impacting vendor expectations. The median vendor discount, or the amount a vendor needs to bargain downwards to achieve a sale, hasn't moved. In short, any calls that the residential property may slow dramatically in the short term would appear premature. This final slide on the property market takes a look at the demand-supply dynamic to get a gauge on the direction of the market. Currently, it's supportive of continued price growth. In recent months, you can see that both new listings and total listings have fallen. There's not a huge amount of new stock on the market, meaning total market stock is low. On the flip side, demand for property has held steady from its post-COVID surge. The net result is that demand continues to outstrip supply, and in any market, that will ultimately drive the outcome. Well, that concludes our review of the economy and property market. We look forward to bringing you fresh updates in our next investor call.
Thank you for taking the time to participate in our September investor call. If you would like to discuss your investments with us or to speak to us on any of the many topics from today's investor call, please contact any of our friendly investment team on 1-800-818-818.